When Ethereum first launched, most people ignored it. Bitcoin dominated the headlines and Ethereum was just another altcoin. But those who took the time to understand its potential saw it rise from a few dollars to thousands. The same thing happened with Solana and Binance Coin. I have learned that the biggest opportunities in crypto rarely come from what is trending. They come from spotting value before the crowd catches on. In this video, I will show you how to identify the next big cryptocurrency before it takes off. Understanding market trends and cycles. Cryptocurrency moves in cycles, and recognizing these patterns can give you a serious advantage. Prices do not just rise forever, and they do not crash without reason. It all comes down to market psychology and investor behavior. Bull markets bring excitement. People rush in, thinking they are about to strike gold. Prices surge, and even questionable projects gain traction. This is when media coverage is at its peak and social media is filled with price predictions. But eventually, hype fades and the market cools down. That is when bear markets take over. Prices drop, investors panic, and many lose interest. However, bear markets are where the real opportunities exist. Solid projects continue building during these phases, while weaker ones disappear. The last bull run saw explosive growth in meme coins and metaverse projects. But as trends shift, new narratives emerge. Right now, artificial intelligence and real-world asset tokenization are gaining attention. Keeping an eye on what investors are talking about can help you identify early opportunities. Understanding where we are in the cycle is key. If the market is heating up, it is best to be cautious. If things are quiet, that might be the perfect time to research promising projects. Long-term success comes from thinking ahead, not chasing what is already popular. Key fundamentals that make a cryptocurrency valuable. Not all cryptocurrencies are created equal. Some have real-world value, while others exist purely as speculation. The key to spotting potential is knowing what makes a project stand out. First, a strong use case is everything. If a cryptocurrency does not solve a real problem, its success is purely based on hype. Bitcoin works as a store of value. Ethereum powers smart contracts, and stablecoins provide a hedge against volatility. A coin with no clear purpose is unlikely to last. Technology also plays a huge role. A strong blockchain should be scalable, secure, and decentralized. If transactions are slow and fees are high, adoption will be difficult. This is why networks like Solana and Avalanche gain traction. They solved Ethereum's congestion issues. Developer activity is another important sign of long-term potential. A project with a strong team constantly improving its technology is a good sign. You can check GitHub repositories to see how active developers are. If there are barely any updates, that is a red flag. Community support cannot be ignored. If people believe in a project and actively use it, it has a better chance of surviving market downturns. Look for engaged communities, not just hype-driven ones. A strong following can drive real adoption, which leads to long-term growth. My take on what separates hidden gems from hype coins. Over the years, I have seen promising projects go unnoticed while overhyped ones get millions in investment before crashing. It is easy to get distracted by marketing, but the real winners usually take time to gain recognition. One thing I always check is how a project is being promoted. If it relies too much on celebrity endorsements and paid influencers, that is a warning sign. Genuine projects do not need constant hype to survive. They focus on development and adoption. Another mistake I used to make was ignoring token distribution. If a few wallets hold most of the supply, that is a disaster waiting to happen. Large holders or whales can manipulate the price and dump tokens on retail investors. It is always important to check how tokens are allocated. Bias is another problem. Sometimes people get emotionally attached to a coin just because they bought in early. I have learned that it is best to stay objective. If the fundamentals are weak, it does not matter how much I want it to succeed. Sticking to logic over emotion has saved me from bad investments more than once. Evaluating the team behind the project. A great idea means nothing without the right people to execute it. The team behind a cryptocurrency plays a major role in its success or failure. The first step is researching the founders and developers. Do they have experience in blockchain or tech? Have they worked on successful projects before? If the team is anonymous, that is a red flag. While privacy is important in crypto, trusting an unknown group with your money is risky. Checking LinkedIn profiles, past projects, and interviews can tell you a lot. If a team has a history of failed or abandoned projects, it is worth being cautious. Some developers jump from one project to another, launching tokens with no real intention of delivering results. Examples from the past show how important leadership is. Ethereum succeeded largely because of Vitalik Buterin's vision and technical expertise. Cardano grew under Charles Hoskinson's leadership. Meanwhile, projects like Terra collapsed due to poor risk management. A strong team does not guarantee success, but a weak or inexperienced one almost guarantees failure. Doing a background check before investing can save a lot of regret later. Tokenomics and supply mechanics that influence growth. Many people focus on price but ignore tokenomics. Understanding how a token is structured can tell you if it has long-term potential or if it is designed for short-term gains. Supply is one of the biggest factors. A low-supply coin tends to have higher price potential, while coins with trillions of tokens often struggle to gain value. Circulating supply also matters. If a large percentage of tokens are still locked, future releases could flood the market and drive prices down. Vesting schedules are another key detail. If developers and early investors hold too many tokens and their lockup period ends soon, there's a chance they will sell, causing a price drop. Checking the token release schedule can help avoid surprises. Whale activity is something many ignore. If a few wallets own most of the supply, they can manipulate the market. A healthy project has a balanced distribution where tokens are spread among many holders. Utility is the final piece of the puzzle. If a token has no real use case, demand will eventually fade. The strongest projects have tokens that serve a purpose, like paying for transactions, staking, or governance. The more useful a token is, the better its long-term outlook. My observation on how social media and hype impact crypto prices. If there is one thing that can send a coin skyrocketing or crashing overnight, it is social media. Over the years, I have seen how platforms like Twitter and Reddit shape the crypto market. Influencers have way more power than most people realize. When a big name promotes a coin, thousands of people jump in without research. This is how meme coins explode. But the problem is, hype does not last forever. Once the excitement fades, prices drop just as fast. Pump and dump schemes are everywhere. A group hypes up a coin, gets people to buy, then sells their holdings, leaving new investors with losses. I have learned to stay skeptical when I see coins trending for no reason. If the only thing supporting a project is hype, it is a bad investment. One trick I use is checking engagement levels. If a project has millions of followers but barely any discussions or questions, it is likely filled with bots. Real communities have meaningful conversations, not just price predictions. Hype can bring short-term gains, but long-term success comes from real development. Separating noise from value is what makes the difference between profit and regret. The role of regulations and government policies in crypto's future. One thing that does not get enough attention is how regulations affect the cryptocurrency market. Many people focus on technology and hype, but laws can make or break a project. Governments around the world are constantly changing their stance on digital assets, and that can impact prices and adoption. Regulations can be a good thing. When governments create clear rules, big institutions feel more comfortable investing. This brings stability and long-term growth. The approval of spot Bitcoin ETFs in the United States was a perfect example. It gave legitimacy to the industry and brought in new money from traditional investors. On the other hand, restrictive policies can kill innovation. Some countries have banned cryptocurrencies or made it difficult for exchanges to operate. When China cracked down on Bitcoin mining, the market took a huge hit. But the miners simply relocated to other countries, proving that crypto is not easy to stop. Keeping track of new regulations is important for investors. Laws can impact which coins survive and which ones struggle. Following news from organizations like the SEC, European regulators, and Asian markets can give you an edge. Being aware of legal changes helps in making smarter investment decisions. Crypto is always evolving, and the best opportunities come to those who stay ahead of the trends. The real question is, are you prepared to spot them before everyone else does? Let me know in the comments what you look for in a promising project. If you enjoyed this video, give it a thumbs up and subscribe for more content like this.